Okay, hi everyone, welcome to today's webinar. So for today, we're going to be talking about three powerful reversal strategies. So we're going to give a bit more time to let more people join our session before we get started. So in the meantime, let me know if you guys can see me and hear me. And yeah, we'll start in about 1 more minute. Thanks everyone. Okay, let's go ahead and get started. So for those of you guys who've just joined, welcome. So today we're talking about three powerful reversal techniques. And yeah, let's just go ahead and get started. So as per usual, a disclaimer before we get started. IC Markets Global does not represent that the material provided here is accurate, complete, or current, and therefore shouldn't be relied upon as such. The information provided here, whether from third party or not, is not to be considered as a recommendation, an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. Risk warning: trading forex and CFDs carries a high level of risk to your capital, and you should only trade with money you can afford to lose. Trading forex and CFDs may not be suitable for all investors, so please ensure that you fully understand the risk involved and seek independent advice if necessary. Please read and ensure you fully understand our risk disclosure. Okay, so I'm your host for today. I'm Melanie. I'm an investment analyst at Rocket, who were finalists for Best FX and Equity Research in the years 2019 to 2021, with a specialization in technical analysis, focusing on Fibonacci retracements, extensions, and projections. So we're going to be touching a bit on those techniques today. Um, so here's our agenda for today. These are the three kinds of reversal techniques that we're going to be talking about. We're going to start off with the pullback, followed by the Nike tick, and lastly, the Fibonacci retracement. Okay, so all of these techniques are pretty closely related to scalping, and they are also techniques that we would typically recommend for scalping, which is why I'm gonna really briefly go through what exactly it is and how you can use the three techniques that we're gonna be talking about for your scalping strategy. So what exactly is scalping? It's basically a fast-paced, exciting, and mind-rattling strategy, and it's used for shorter time periods between the opening and the closing of a trade, and it's to grab very small amounts of pips, and you get to risk very small amount of pips as well. And this technique uses or takes advantage of market volatility. So why is it important, or why should you scalp? You're able to avoid known unknowns. So a good example of known unknowns is the NFP. So if you search up, for example, an economic calendar, you would know an event is coming up, but the outcome is unknown. So these events can really mess up your trade. So a locus of control, 20 pips versus 200 pips. For example, if we use the example of a weather forecast, you would have the 1 hour forecast versus the 1 week forecast. You tend to get a more accurate view over what's happening over the next hour rather than over the next 1 week. And lastly, is that opportunities. There are new opportunities every time you open the chart. So the market moves pretty fast on the M30 and the H1 timeframes, so there are new patterns every couple of hours. So how much time do you need to scalp? The holding time can range from a few seconds to a few hours. The time commitment tends to be pretty short. It's typically 1 hour in the morning, an hour in the afternoon, and an hour in the evening. So how it works is you typically would find the trade, set the trade management, and then you're pretty much done. And you want to try and review your trade every few hours. So it's important to have proper risk management so that you don't need to monitor the trades all the way. How much leverage do you need to scalp? Pretty high leverage. We typically would use 1 to 100 onwards, and you would use low spread pairs. How much capital do you need to scalp? So a good amount to start with is 250. Decent leverage of at least 1 to 100 is preferred, but not necessary. So a trader who deposits $1,000 can use $100,000 with 100 to 1 leverage in the market, which can greatly magnify your returns, but also your losses. So this is considered acceptable as long as only 1% or less of the trader's capital is risked on each trade. So this means that with an average account size of maybe $1,000, only $10 of each should be risked on each trade. So while this is difficult in practice, traders should avoid the temptation of trying to turn their $1,000 into $2,000 really quickly. So yeah, that's why we say that if you can do it with 250, then you can probably do it with 2,500 and 25,000. But we typically recommend you not to rush into scaling upwards. Okay, now let's get into our 3 powerful scalping strategies. We're going to start off by talking about the horizontal pullback strategy. This is really easy to do, followed by the Fibonacci retracement, and lastly, our Nike tick strategy. So, yeah, we're also going to do a few of these techniques on our charts. So if you guys have any requests for any charts that you'd like me to go through, feel free to pop them into the chat as well. Okay, let's get started. So firstly, we're going to start off with our horizontal pullback. So this is an example of that. Firstly, you can see that the start of our chart, price is testing the red highlighted area 3 times at our swing highs. And then price breaks out of that area and we are expecting it to retrace back to this level. So that's why we call it a pullback, because we're expecting price to pull back to that same level. So this level is basically called a horizontal pullback or just a pullback support, since we're expecting price to retrace back to the same level. It's a support because we're expecting prices to bounce off of it again. Here we have an example of a pullback resistance. So basically here we see the opposite of what we had previously. We have 3 levels or 3 swing lows testing this area, and it's a support level. And then once price breaks out of it, then it becomes a pullback resistance since we're expecting price to retrace back to that level. Okay. Next we have this other example as well, where price is testing, price had bounced off of this support level, and then it reversed back and it broke out of that level, hit it downwards, and it's now a pullback resistance. that's moving below our Ichimoku cloud. So we're expecting price to reverse back to this area here. That's why we're calling it a pullback. You can see that's exactly what it did here. Okay, next we're going to move on to our Fibonacci retracement. And Fibonacci retracement is basically when okay, this is just to show you what you should avoid. But let me pull out my charts and show you what it is. Okay. So just as an example, okay, your Fibonacci retracement would be, in this case, we are using from here to maybe here. Okay, you can see my 50% lines up with this level here. So basically what a retracement is it follows, firstly, it has to follow the shape of your price. Secondly, we use 3 levels, or rather 5 levels. Let me see. Okay, we use 5 levels. Okay, the 23.6, 38.2, 50%, 61.8, 78.6. Okay, so whenever you're using a retracement, we would use these 5 levels. And then we see where price has reversed or tested. So in this case, we see price has tested or reversed off of this 50% level here. Okay, and you can see how nicely price bounced off of this level. So that's basically what a retracement is. Some things to avoid. Yeah. So some things to avoid is avoiding using really insignificant swing highs or lows. So these are bad to use for Fibonacci points. So your swing highs and lows should look something like this, where they are pretty significant, like what we have here. So you can see the shape of the swing highs and the swing lows over here. Here as well. Okay. So something that you want to avoid as well is avoid cutting through the shape of your chart. So you want to try and make sure that you follow the shape as closely as possible. So something like this, you can see even though there is a little bit of deviation from my Fibonacci trend line, but ultimately it is still pretty similar and it doesn't cut through it like this. Okay, so how it works in this example, you can see we're drawing our Fibonacci trend line. And we're going to see if it aligns with any of the mid-range levels that we mentioned earlier. 23, 38.2, 50, 61.8, and 78.6. Okay, so this is how to combine our Fibonacci retracement with our pullback that we learned earlier. So here we have our pullback on the euro dollar, and it's in line with two swing lows, and price broke below the level, and we're expecting it to retrace back to this level here. Now we see price is, or rather, our pullback level is also in line with our Fibonacci retracement, the 61.8. Okay. And we have another retracement between this higher swing high and this swing low here. And our 50% lines up with the 61.8 as well as our pullback level. So you can see ultimately that's exactly what happened. Price retraced back to our level and was unable to break through it. because this is a Fibonacci confluence area. So basically, when you have two or more Fibonacci levels that line up, like in this case, it's a Fibonacci confluence area, and these areas tend to attract price, but price might not be able to break past it. So which you can see here, it attracted price, and then it broke. It rebounded off and hit it back down. Okay. So this is an example of using our Fibonacci retracement plus pullback plus an Ichimoku. So in this case, you can see price moving within the cloud, and it looks like it's breaking out of it. And we also have price moving in this descending trend line with two swing highs. Okay, and we also have a Fibonacci retracement here, where price is kind of approaching this 38.2 retracement level. Okay, so all of that in combination with our stochastic, in which you can see um, we have this what we call a hidden resistance level, which is basically when on our stochastic or our RSI indicators, when they show us that price is testing a hidden resistance, but we clearly see on our price chart that it's moving in a descending trend line instead. Okay, so this basically tells us that price is likely to break out, or rather continue in this descending trend line. Okay, so it rebounded off of 38.2, reversed off of this descending trend line, and moved below our Ichimoku cloud. Okay, so it was all very bearish indicators as well. Okay, so next we're going to move on to our Nike tick strategy. Here we can see that our how a Nike tick strategy works basically is we're using the levels that are greater than 100%. So earlier we used the mid-range for Fibonacci retracement between 23.6 to 78.6. Okay, but for Fibonacci extension, which is what we call our Nike tick strategy, we are using the levels that are greater than 100%. Okay, we'll get into negative Fibonacci retracement another time, but for now, let's just focus on the levels that are greater than 100. So one example is over here. You can spot the Nike tick pretty clearly. It's basically just a V shape. It's a V shape, but you want to make sure that the tail of the V is longer than the head of the V. So we make sure that the second line is greater than the first line. So it surpasses 100% of the Fibonacci retracement. So here in this example, we have our starting point and ending point, and you can see really clearly the shape, and we're projecting this price to reverse off of the 161.8. Okay, which you can see it did happen over here. Okay, so here's an example of what we're looking for. Okay, yeah, so basically you can see the V shape, and we are observing the 127.2 and the 161.8. So you can see how it reverses off the 161, and we're expecting it to hit back downwards. Okay. Okay, I need to edit this chart. So sorry. Okay, so in this example, we're using for this example, this technique, we use three kinds of time frames, mainly the shorter time frames, so between M30, H1, as well as the H4. Okay, so sorry about that. Okay, this should be a lot clearer. So we're using the M30, H1, and H4. Our entry criteria is if price breaks out of the 127.2 or if it reverses behind the 127.2. So the level that we're looking at is over here. Stop loss we would typically place at the 145%. Idea invalidation we'll place at the 138. And a break even would be 11% of the move, the recent move, 50% take profit, 11% of the recent move, and our full take profit would be 22% of our recent move. Bonus would be if your levels line up with any Fibonacci retracements, expansions, projections, and any support or resistance. Okay? Here's a long example. So over here, you can see we are going in for a sell since price reversed off these levels. Over here, you can see since price reversed off this 127.2, that lines up nicely with the 61.8. That's why we are going in for a buy. Okay. Okay, here's a short example. So here we have our 100% Fibonacci projection that lines up nicely with our 127.2% Fibonacci extension. So this is what we call, again, a Fibonacci confluence level, and we're expecting prices to reverse off of it, which did happen over here. Okay. Okay, why is my... Okay, so before we get into our charts, let me just show you guys this website in case you're a bit confused with what I've been talking about so far with all the Fibonacci names and so on and so forth. Feel free to check out the forexarmy.com. It's a completely free website, and yeah, so we go through some techniques on Fibonacci retracements that we're going to talk a bit more in depth about in this webinar, and we're talking about extensions as well. But yeah, if you're confused, feel free to check out these videos as well after this. And we give you some tips on what to look out for. So like a clear market structure, how to change your time frames so that you make sure you're analyzing on a clear market structure. And yeah, so some of these we've gone through already, and some guidelines as well, what to look out for. Any invalid Fibonacci retracements. So it's important for you to start from the starting point and the ending point. So if price in which the starting point is the highest point and the ending point is your lowest point. So if price breaks our ending point on the right, we cannot use this point as a Fibonacci retracement. Okay? So we also go through the expansion levels, which are the negative levels. And I'm not going to go through this today. I'm also not going to go through any projections. So yeah, feel free to check this out on your own. But yeah, so this is what I was talking about with a confluence. So in this example, we have prices lining up at our 50% to 241.4% and 127.2%. So since we have such a strong confluence area, we're expecting prices to reverse off of it. Okay, that's why it's important for us to spot any of these kinds of confluence areas. So in this example, we have three different types of Fibonacci. We have a projection, which uses this flash or lightning bolt kind of shape indicated by your yellow arrows. Then we have our 88% Fibonacci extension and your 61.8% Fibonacci retracement. Oh, we have another one, another 61.8% Fibonacci extension over here. Okay, so over here we see price reverse off of this strong confluence area again. Okay, so yeah, I think you guys kind of get it by now. Yeah, we also go through some trade management techniques, how you should place your stop loss beyond and your take profit before any Fibonacci confluence areas. And this applies beyond Fibonacci as well, even if it's just a strong resistance area or support area, this applies for that as well. Reason being that praise is often attracted to such strong areas of Fibonacci confluence, so you might get stopped out before the market reverses and take profit before because once price reaches your area, there's a high chance it won't be able to go beyond it. Okay, so it might reverse back to your entry instead. An example would be over here as our buy entry. If your take profit is so if you're going in for buy, you place your take profit below your Fibonacci confluence and you place your stop loss below your Fibonacci confluence as well. So you can imagine if you're doing a sell entry, it would then be the opposite. Okay, now we have a little bit of time. So I'm gonna go through some charts and see if we can implement what we've learned so far into our charts. Okay, since I have this open, let's just go ahead and analyze this together. So I'd like to start off on the weekly time frame, just so we get an idea of where prices are headed towards. Okay, so you can see prices are kind of ranging. There isn't really a clear there isn't really a clear trend over here. Now let's look at our daily time frame. Okay, on our daily time frame, it looks pretty bearish. Okay, with prices moving in this descending trend line. Okay, let's go ahead and analyze on our 4 or 1 hour time frames. So how you decide is, of course, firstly, depending on your own trading technique, your own strategy, but also by seeing if there are clearer charts, which is the clearer chart between the 4 hour and the 1 hour time frames. I'm gonna go ahead and analyze this on our 1 hour time frame instead. Okay, so let's get started. Okay, so on our 1 hour chart, I'm going to place my pivot here and my first resistance over here. And my first support way down here. So you can see when price, okay, something like this, when there's a swing low and a swing high that line up, this is what we call a overlap level. Okay, and then what we went through earlier is if something like this for our pivot, we have a swing low, price breaks below the swing low support and it reverses. This is what we call a pullback. Okay, that's what we just went through. And yeah, I think let's go ahead and okay, so now that we have our horizontal levels, the next step is to go in with our Fibonacci levels to support these levels. Okay, so I'm gonna go in with a retracement. Okay, you can see my 50% lines up with my first support. So I'm just gonna keep that to make sure that my charts aren't so messy. Um, I'm also gonna go in with my projection. Okay, you can see the 100% lines up with my pivot. Okay. Next I'm gonna go in with another retracement. And my 61.8 lines up with my first resistance. My 38.2 also lines up with my pivot. 61 and 38. Okay, so these levels don't have to line up exactly on your horizontal levels because we're looking for confluence areas more so than specific levels. Okay, I'm gonna place another retracement here. Okay, we can see my 50% lines up. Okay, so we have a bit of a confluence area here and here as well. Okay, I think that's all the levels that we have. Um, Let me just double check. Okay, so something like this, even though even though our 100% lines up with our pivot, we can't use it because price has already broken out of it. So in this case, we're using a projection. We're using a projection, and for projections, we use this flash kind of shape. Um, and you can see that price has broken below these levels. Okay, so I'm gonna remove that. Okay, now let's look at some indicators. Ichimoku MACD. I like to look at Ichimoku and MACD first because at one glance you can see exactly what the signals are. So for our Ichimoku, price is moving within the cloud, and MACD is kind of giving us a bullish signal a little bit. Okay, but since this is um a pullback and it's also a confluence area, I'm actually expecting prices to reverse off of it. Okay, let's look at some other indicators as well. Let's look at our MACD. Okay, you can see price recently broke above our moving averages, which is a bullish signal. Let's look at stochastic. Okay, so you can see here that we have our hidden resistances again. Okay, so between these levels, particularly here and here, that price was actually moving downwards. Maybe not here because it was at the same level. Okay, so between these two levels, price was actually moving downwards, but it was showing us a um, hidden resistance on our stochastic. So that is a sign that price might continue to drop. So I'm just going to keep those two and our Ichimoku as well. Okay, so because we have our pullback level and we also have this Ichimoku, not Ichimoku, confluence level here with our 38.2 and 50%, actually, and also this 100%. Okay, so that's why we're expecting price to reverse off and hit back down to our first support. Okay, any questions? Okay, if not, let's take a look at one more example. Maybe you can look at um maybe you can look at DXY. Now on our weekly time frame, you can see prices are kind of ranging again. On our daily time frame, price looks like it's moving in this uptrend. Okay. Let's look at our 4 hours time frame. Okay, 4 hours also look pretty bullish. Okay, no trend line here, but it does look like it's moving in this uptrend. Now let's go ahead and add our support and resistance levels again. So I'll place my pivot maybe here. Okay, let's look at our 1 hour time frame. Okay, I think I'll analyze on our 1 hour time frame instead. Okay, so I'll place my pivot here. First resistance here. Or maybe here. Okay, because we have so many swing lows here. And then our first support here. So again, we see price test this level here many times, break below it, and that's why it's our first resistance. This is our pullback resistance, and I'm expecting prices to hit back there, or retrace back there. Okay, now let's go in with our support and resistance levels again. 38.2 and 50% both line up. And okay, I have a 100% Fibonacci retracement that lines up. My 78 also lines up. Okay. And lastly, I also have this projection. My 100% also lines up. Okay, so because we have such a huge confluence area here, I'm expecting price to be attracted to that area and hit upwards. Okay, now let's take a look at some indicators. Let's look at our Ichimoku and MACD again. Ichimoku, you can see price recently broke above the cloud, so it is giving us a bullish signal. MACD, you can see, is also giving us a bullish signal. If we look at our moving averages, price is moving above the moving averages, so it's also bullish. And um okay, stochastic isn't telling us much. Let's look at Bollinger Bands. Okay, you can see on our upper band, price is pushing above the upper band for our Bollinger Bands, so it also gives us a bullish signal. Okay, okay. Do you guys have any questions? Any other charts you'd like me to go through? Okay, if not, that brings us to the end of our session. Thank you guys so much for joining me today. I hope you guys found this session helpful. And yep, see you guys again next week. Have a great rest of your week. Thanks, everyone. Bye.